Welcome to P2 Corporate Reporting. In this section, we are going to look at the effect of changes in accounting standards on accounting systems. If you believed that you only needed to learn the accounting standards once, and that the rules that you are learning to pass the P2 exam will stay the same forever, I hate to be the bearer of bad news, because they will not remain the same. Think about it. If they did, we would end up with a not-for-purpose system, unable to provide us with relevant and meaningful reports. So the accounting standards themselves change over time, and new ones are developed. And businesses may decide to adopt an accounting standard to better represent their financial statements. For example, we looked at IFRS for SMEs. Before this standard was introduced, SMEs were using the full standard or local GAAP. And when the IFRS for SMEs came along, they adopted it as it met their information needs better. In that first year, how did they implement that new standard? When we change standards, it can change the valuations of assets and liabilities. It can also change the way income and expenses are represented. IFRS 1 guides us in first-time adoption of international financial reporting standards. You will not have seen this standard before, so let's look at it now. Here, we learn how to apply a first-time adoption of a body of new accounting standards, the IFRS. How would a company go about that? For example, ABC Incorporated decides to adopt IFRS for the first time in their 20x7 financial statements. How would they do this? 1. They must prepare both 20x7 and 20x6 financial statements according to IFRS. The opening 20x6 balance sheet must be prepared with IFRS, assuming that it is a full financial period. Their 20x7 financial statements will contain 3 statements of financial position or balance sheet. 20x7, 20x6 and 20x5 are the 3 years. 2 statements of profit or loss and other comprehensive income for 20x7 and 20x6. 2 statements of cash flows and 2 statements of changes in equity for 20x7 and 20x6. And the related notes, including comparative information. Now, by adopting the IFRS, it is likely that there are differences between the financial statements. Some assets and liabilities recognised under GAAP, or generally accepted accounting practices, are not recognised under IFRS. For example, IAS 38 doesn't allow training to be capitalised as an intangible asset. What if the GAAP does? And there is an asset for training included in the balance sheet. This must be derecognised in the opening IFRS balance sheet. In the example of ABC Incorporated, anything included in the opening balance sheet that is not allowable under IFRS is derecognised. That includes contingent liabilities, provisions, assets, or anything that is not allowed under IFRS. And if we are derecognising the assets and liabilities not allowed under IFRS, we should recognise the assets and liabilities that are allowed under IFRS and not under GAAP. So ABC's opening balance sheet, the one for the beginning of 20x6, will include the assets and liabilities not recorded under GAAP. These could include all derivative financial assets and liabilities, including embedded derivatives as per IAS 39, or employee future benefits not recognised under IAS 19, or deferred tax assets and liabilities according to IAS 12. These changes in measurement will change the values of assets and liabilities. These should either be recognised in the retained earnings or another suitable equity category at the date of transition to IFRS. Then, some reclassification may be needed, reclassifying the items in the opening balance sheet to the appropriate IFRS classification. So, for example, the GAAP may have allowed assets and liabilities be offset against each other. However, under IFRS, these assets and liabilities will have to be classified separately because the company must apply the IFRS to a minimum of 3 statements of financial position and 2 statements of income. They are applying it retrospectively and may have to use best estimates to apply the IFRS. And as with any standard, and when there is such a fundamental change in the financial statements, we would have to make a disclosure in the financial statements. IFRS 1 requires disclosures that explain how the transition from previous GAAP to IFRS affected the entity's reported financial position, financial performance, and cash flows. So it needs to include reconciliations of equity reported under previous GAAP to equity under IFRS, both at the date of transition to IFRS and at the end of the last annual period reported under the previous GAAP. So back to our example of ABC. They are adopting IFRS for the first time in its 31 December 20x7 financial statements. So the reconciliations would be as of 1 January 20x5 and 31st of December 20x6. 2. Reconciliations of total comprehensive income for the last annual period reported under previous GAAP to total comprehensive income under IFRS for the same period. For ABC, that would be the 20x6 financial statements. 3. An explanation of material adjustments that were made in adopting IFRSs for the first time to the statement of financial position, statement of comprehensive income, and statement of cash flows. And if errors in previous GAAP financial statements are found, they must be disclosed separately. Any impairment losses recognised or reversed when preparing the opening IFRS balance sheet. For ABC, that is the opening 20x6 balance sheet, must be disclosed. 5. An explanation if the entity has elected to apply any of the specific recognition and measurement exemptions permitted under IFRS. There are a limited amount of exemptions that apply for the retroactive application of the IFRS. They cover IAS 39 regarding financial assets and hedging, IAS 27, the non-controlling interest, IAS 19, employee benefits, and IAS 21. If these exemptions are used, they must be disclosed. Adopting IFRS for the first time is a big deal. You can see that a lot of work is necessary. It is not a decision that should be taken lightly, and it is important that the company, from then on, applies IFRS fully. They can't chop and change between GAAP and IFRS. Thank you.